Let's bring in Chris Senyek of Wolfe Research. Alicia Levine said something interesting, Chris, at the top of the hour. She said that there will be a point at which you want to be buying growth stocks if the economy slows down. How do we know when we're at that point?
We think the economy is going to slow down during the course of the year because when the Fed's historically hiked rates more than 200 basis points, which is what the forecast is, and then some for this year, the economy's really slowed down. You're already starting to see that with ISM decelerating. You saw the Philly Fed report this morning, which was also weaker. And you throw on higher interest rates and the effect of that, which take time to digest itself through the economy. And we see the economy really slowing. So we would take the opposite side of that trade. We would be long value stocks here over growth. I don't think you want to own growth stocks. Those are generally the higher multiple stocks. And if interest rates continue to rise, those long duration assets are going to continue to underperform the market.
What type of value stocks? What sectors?
We would do value in healthcare. We like pharma in particular. We like tobacco stocks within staples, more defensive areas. If you have to own tech stocks, wait till they report earnings, let them de-risk. We lean in towards value within tech. So that's the payment processors, that's IT services.
Mike, what is the message we're getting from earnings overall? You know, some of these companies have pretty strong pricing power. I'm looking at a Dow, which is set to close at a record high right now. What are you hearing as it relates to the overall market? And is the market paying attention?
Market is paying attention in the sense that there's been a bit of, on a net basis, relief on the results. If you looked at the average stock reaction to earnings, it's actually slightly positive. Obviously, the massive blowups like, Netflix are going to obscure some of that. But company by company, things were down enough, stocks were down enough, I think that the bar was somewhat lowered. Overall, estimates are holding up for the year. I think it's fair to argue that the back half of the year, you might have some vulnerability to those forecasts, and it is lumpy. Energy's doing a lot of the work in terms of keeping the overall forecasts supported. But I don't think that what the market is mostly going through right now is a panic about corporate results. The corporate sector seems pretty sturdy. It's all about what you pay for the earnings, what the trajectory is, if we are going to see further margin squeezes, and the interest rate that you're going to have to kind of compete against as a hurdle rate.
So what do you think that we're going through, Mike, then? Just a valuation reset as the Fed increasingly, expeditiously is the word, looks to raise interest rates and front load these rate hikes?
I mean, that's most of it. I will not deny that the market is also telling you we've rushed into some version of a late cycle environment. That's what the sector leadership tells you. That's what it tells you when the Fed is in a hurry to try and restrain inflation. It doesn't mean late is on an actual clock. It can stay late for a long time. You could also mean revert. The leading economic indicators today at a new high. On average, it's been like almost a year after those peak before you get a recession. So it's not as if there's only a few grains of sand left in the hourglass here.
I also want to point out, Chris, the dollar, which is strengthening. It's another byproduct of all this Fed hiking. It's up another 0.25%, hitting some multi-year highs against currencies like the Chinese currency, the Japanese yen, a more than 20-year high, the euro even. Have investors factored that in, do you think, to the earnings outlook?
No, that's not in earnings estimates yet. Obviously, that hits some of the multinational companies. Certainly, I think some of the relative strength in the U.S. market has been attributable to foreign inflows, trying to get benefits from the currency. But estimates don't yet reflect that weaker currency. So some of the multinationals may have some more conservative guidance this earnings season as a result of that.
When you say you like value, I know you said healthcare was one of your picks and staples, sort of the defensive groups, but to wait on earnings for technology. Do you see any value at this point in technology, maybe in some of the mega cap names, which are getting beat up again today?
Well, the short answer is not yet, because we think investors after the Netflix news are starting to question the sustainability of tech spending. So they extrapolate, okay, it's just streaming, it's just stay at home. And now is cloud spending going to come under pressure, right? Is this like the late 90s where we were assuming that spending was going to continue to grow at an unachievable rate in perpetuity? And so we need a little more clarity on software names. I think before we want to dabble in there, we'd be leaning towards software post EPS if we see some good and solid results and get confidence that cloud spending isn't going to fall off a cliff either.